everyone. Jeff Fratarcangeli here for another call to action. Here we are, already kicking off the new year. Feels like we've been in the 2026 year for longer than, call it, 7 trading days, but we're off to the races. A lot going on, a lot to unveil and a lot to get through as it relates to what are we doing today? How is 2026 lining up? We're in the midst of an election year, all sorts of good things to touch on here for the next half hour to 45 minutes. Those of you that are joining us for the first time, Fratarcangeli Wealth Management crossed its 30-year anniversary last year in December, where I started in the industry at a firm called Dean Witter, where I was working in the World Trade Center, Tower 2, training as a young, call it sponge, if you will, and taking it all in for the first time in New York. And then I came back and started building a practice that today, as we sit 30 years later, oversees several billions of dollars, has a team of over 35 professionals, offices in 4 states, clients in all 50 states, and we take a holistic approach and surrounding our clients, their businesses, their families, their foundations, and all that comes with their money as well as vision, and create a competitive environment to create solutions, whether it be on the asset management and investment side, retirement planning, estate planning, tax planning, having an event in investment banking, and all sorts of other things, including benefits and mortgages and leverage. We make it our business to create a competitive environment for our clients to choose from a basket of solutions that align to their objectives and giving them some taste of what they need to be considering that they're maybe approaching for the first time that we've dealt with, in my case, for 30 years, and our team's case for over 300 years. And so we're so passionate and honored to be a part of many of your teams, and knowing that we've been ranked amongst the best now for, call it, 5 consecutive years, top 50 in the nation by Forbes, #1 in our states. I'm just so proud of my team for giving it everything we have, and the leverage that we have access to, whether it be on the platform that our custodian at Wells Fargo provides, or whether it be outside resources, or the, call it, experience of our team ranging from CFPs to CFAs and retirement planning specialists, folks that I've been able to handpick throughout the years over my experiences. We are just extremely honored to be in this position and having folks to leverage. And many of you may recognize the gentleman on our screen. His name is Jeff Bush. He's the top political analyst when it comes to understanding and interpreting what's coming out of Washington and how it relates to Main Street and Wall Street. And many of you may recognize him because I leveraged his brain and his knowledge last election, which was in 2024, and did prior to that as well in other elections. And I got to tell you, the guy knows his stuff. He gives us great direction, tells us the probability, tells us what the outcome can be. And I'm not going to lie to you all. I picked his brain prior to this call a little bit, and I'm excited for you to hear what he has to say. You may have seen him on CNBC. Not only does he speak across the world 200 times a year as a sought-after presenter and an expert in this particular space, but he's also been on stage with former Fed chairs like Bernanke and many of the like. He's been in meetings and presentations with CEOs of public companies like John Thiel and so many of the like. It's our honor to be able to leverage you and your brain and your experiences today in my audience, being able to watch this live as well as potentially retape it. And geez, there's so much going on. And we have an election year upon us. Once again, a midterm election. And, you know, right now we have 3 bodies of government controlled by a very slim margin by the Republicans. And if I've learned anything in 30 years, it's that there's a 90% probability one of those 2 bodies of government, the House or the Senate, will probably flip back. And how does that going to affect us? What's going on with tariffs? What's the Supreme Court judgment that we're all waiting to hear? How do we navigate the situation with foreign affairs? And every day we wake up wondering, what are we going to see today that's going on in Washington? So, Jeff, I'm going to try to be quiet. I'm going to let you run here and talk about these topics, and as well use your slide so my audience, who's probably bored with listening to me, can hear it from someone on the front line. So thank you, Jeff, please.
Well, thank you for having me back, Jeff. It's always great to come back and revisit with an audience and so forth. But you really hit the nail on the head. What's unique about Donald Trump's second term is just the pace that he's been on. And the biggest challenge I have is what do you include and what do you exclude from the presentation? Because he's got so many pots on the stove, if you will. So I kind of grouped it into one catch-all area called Let's Talk. And that's where we're going to discuss foreign affairs and the trade bills and, of course, the tax bill. There's some important things we need to understand now that we're actually implementing the one big beautiful bill. But the midterm elections are nigh. They're in November, and we need to start preparing ourselves for what the outcome of that might be and the ramifications for that. And I want to end our time talking about this a little concern I have around some dislocation, both in the economic and the societal sense of that word. So with that as a starting point, let's start by let's talk. And when I think about let's talk, I think you would agree we've all learned about Donald Trump that everything is negotiable. And I would contend that this quote aptly fits Donald Trump's approach. What's mine is mine, and what's yours we'll negotiate. But what most Americans don't realize is who gave us that quote. Who actually shared that quote with us was actually JFK, John F. Kennedy Jr. But it's actually taken out of context. The full quote is JFK Jr. said, we cannot negotiate with people who say, what's mine is mine and what's yours we'll negotiate. So clearly there's a different meaning when JFK said that, as opposed to the way we use that quote today. But as that as a starting point, let's talk about foreign affairs. I think, quite honestly, it's the most exciting and also some of the most concerning times in foreign affairs in my 30 plus years experience in doing this. And what I mean by that is we're clearly moving in the direction of what's being called the Donroe Doctrine, which is a modern take on the Monroe Doctrine, which simply means that the Western Hemisphere should have a superior power amongst the Western Hemisphere, and in this case, the United States. And the other Western Hemisphere countries should serve towards that purpose in a sense of mutual collective support and alignment. Asia can worry about Asia, Europe can worry about Europe, and so forth. We're going to really focus on the Western Hemisphere. And I think that's what we're seeing happening in Venezuela, and obviously the implications there for Cuba, but then also Mexico. Sheinbaum has been handling the Donald Trump transition, I think, quite effectively, even better than in some ways, certainly better than Trudeau in Canada, but now even Mark Carney in Canada. So it'll be interesting to see how that Western philosophy, this new doctrine, actually plays out over time. We're obviously seeing some huge changes in Iran potentially, starting with the nuclear strike that Donald Trump put on Iran to take out their nuclear program. I should be more careful the way I say that. But then in addition to that, this new populist uprising. And what's unique about this populist uprising this time, it was not because of social issues. It was because of a banking issue. A bank failed, and it was a very prominent bank throughout Iran, and therefore it set off tremendous inflation in the country. So it really was an organic, broad-based populist uprising that makes this feel a little more unique than what we've seen in other uprisings. And I think we all agree, we're hopeful that we see a regime change in Iran. Now, beyond that, though, you obviously have the Ukraine-Russia situation. That seems to have stalled. I'm not going to be surprised if Donald Trump at some point just kind of washes his hands of that negotiation. Goodness knows he's made several inroads in trying to get to a place of agreement, and they're still working on it. But at some point, I could see him washing his hands of that. And all of this really is focused on where is China in this negotiation. China is the central focus of U.S. foreign affairs and focusing on what's that appropriate relationship moving forward. And I could argue that the whole Ukraine-Russia thing is defining that. Even the Iran situation is defining that relationship with China as well. So moving on from that, though, we know the actual tangible implications of that was really in Donald Trump's second term agenda around trade and tariffs. But there are two types of tariffs that we need to be aware of. The first type are what's called Section 232 tariffs. And those are the industry-based tariffs, things like steel, aluminum, and pharmaceuticals, and even upholstered furniture and the like. Those Section 232 tariffs are completely within the president's authority. There is no question whether President Trump had the authority to implement those types of tariffs. Where he may have gotten over his ski tips, if you'll allow me to use that analogy, is around the country-based tariffs. And I've just listed the countries that we have primary trading relationships with, our biggest trading partners. But of course, we know those agreements are throughout the rest of the world as well. But what I want to call your attention to on these country-based tariffs is that our two biggest trading partners, Mexico and China, neither of those agreements are actually hammered out. For some reasons, the complexity of those relationships, but also just the vastness of those trading relationships. But what's starting to gather actually a little more steam is what's called secondary tariffs. There are countries we have sanctions on, like Russia and Iran, and a lot of our trading partners still trade with those sanctioned countries, Russia and Iran. So Donald Trump is simply saying, hey, look, if you want to trade with us and you still want to trade with Russia and Iran, then we have a problem. And we're going to increase the tariffs on the imports to the United States. So that's an area I'm really watching, especially as it relates to Iran. That's a more recent announcement that he made. But yet at the same time, I think it's going to be a bigger part of that trade discussion this year. In addition to that, our biggest trading relationship agreement is the USMCA, the old NAFTA. That's actually scheduled for renegotiation in 2026. So we have that to look forward to this year on top of everything else. Now, all these country-based tariffs were implemented under something called IEPA, the International Emergency Economic Powers Act. And it's a very novel use of IEPA. And that's why the courts got involved. And now the Supreme Court has heard their arguments. And now we're waiting for the decision from the Supreme Court. All the lower trade courts came back and said, Mr. President, you exceeded your authority under IEPA. Not that you don't have trade authority, you do under 232, but the use of IEPA makes these country-based tariffs rather unique. And I think the Supreme Court's going to uphold the fact that the president exceeded his trade authority under IEPA. Now, theoretically, what that means is Donald Trump has to sit down and write each and every one of us a check for any tariffs that you and I paid through the process of that importation through this tariff environment. Now, you and I both know that's not going to happen. But I think what the Supreme Court's going to come back and say is, Mr. President, you exceeded your authority. We recognize that it would be a near impossibility to go back and rebate all that tariff revenue. And we realize trade's under your authority. So we're just going to allow you to continue under the current environment for X number of months, maybe 6 months. And that would give the president time to refile those tariffs under Section 232, which again, the president has complete authority in. But we are anticipating maybe as soon as next Wednesday, the decision on this tariff from the Supreme Court, which will give us a direction as to what's happening there in that space.
Hey, Jeff,
But
why?
make no mistake about it, from a tariff perspective, we're back where we were during the Smoot-Hawley days. And my contention is the economy of 2026 is very, very different than the economy of 1926. So we don't exactly know how this higher tariffed environment will operate in this modern economy that we all live in today. So that's going to play out throughout this year. But another kind of catch-all area, we know we have a budget deadline at the end of this month, which enveloped in that are the Affordable Care Act enhanced premium subsidies. I do believe that neither party has a desire to see another government shutdown, and they've made some progress on some budget bills. So I think at this point, we will see a worst case, a continued resolution on smaller aspects of the budget through the fiscal year 2026 so that we can move on and not have to deal with that before the election. So I think it's going to be a non-event at the end of the month, this bottom line. We also know the Republicans, while they do control the Senate and the House of Representatives, are once again considering a Republican-only bill. It's called a reconciliation bill. That's how we got the One Big Beautiful Tax Bill last year passed. And they're considering doing another one centered around this issue of affordability. There are a lot of vulnerable Republicans that realize they have a weak front in this area of affordability heading into the midterm elections, and they would like to shore that up. And a reconciliation bill would allow them to do it in a Republican-friendly way. Now, as you know, as I mentioned, we actually passed the One Big Beautiful Bill last year. It's also known as Public Law number 119-21. I personally like to shorten it all. I call it O3B, One Big Beautiful Bill, O3B. So I'll refer to it as O3B. Now, like any tax law, there are good things about it and there are bad things about it. On the good side is it's given us a lot of clarity around the tax code. As you recall, last year when we were going into 2025, we didn't know what the tax code would be in 2026. And so we were kind of having to hedge our bets. Well, now we have a roadmap to follow. And you know as well as I do, if we have a roadmap, we can do a much better job of financial planning. And so we have that clarity. On the not so good side, it will add additional complexity to the already overly complex tax code. There's no doubt about that. And I do not believe that the average American understands that a lot of these provisions that are so popular are time limited or income limited. So I think they're going to be a little bit surprised when they see that kick in this year. But make no mistake about it, this new tax bill
Can I ask you a
will
question? Can I ask
add
you a
to the
question?
debt. Yes, sir.
I hate to throw you off, but the time sensitivity aspect is not something I'm been made aware of. I've seen a lot of differentiating opinions and facts. Can you give us an example of some of the
Sure.
time sensitivity
Yeah,
category?
absolutely. Probably the best example that would impact most of us here is that the state and local tax deduction was increased to $40,000, but only for families with under $500,000 income. And second of all, it only lasts until through 2029. So in 2030, we all go back to 10,000. And that's one example, but I'm actually going to show you several other examples as we get into the nitty-gritty of the tax law. But before I get into that, if we're going to talk about tax law, we need to understand that the Congress uses a very different dictionary when they talk about tax law than what you and I might understand. You and I kind of use the Webster's as our reference point. So let me give you an example. The word temporary in the Webster's dictionary says it's lasting for a limited period of time. But in the Congressional Tax Dictionary, the word temporary is defined as saying lasting for a limited period of time or forever. We just don't know. And another example is the word permanent. In Webster's, it means it's fixed, it's established, you can count on it. But in the Congressional Tax Dictionary, it means it's fixed until we change it. And I say this all with a tongue in cheek, but it's important to realize that the word temporary, the word permanent, when we see it in the tax law, doesn't exactly mean what you and I would normally think of in those terms. So let's dig into the law, and this is where I'll point out some of those points, Jeff. First of all, we know extended the highest marginal tax brackets with a maximum tax bracket of 37%, made that permanent, right? At that 37% level. But then there are some other changes that we need to be aware of. For example, the highest value of your itemized deductions will be capped at 35%. So you may pay 37, but you're going to be capped on your itemized deductions at 35%. Now, notice I highlighted that section. I've highlighted several sections because it brings out a theme that I don't think is getting a lot of attention when the tax law is being discussed. So I'll come back to that when we finish the personal filing section. We increased the estate exemption to 15 million and indexed it from there. And if you're still working and you're participating in 401k catch-up provisions, fantastic, that's great. But if you have more than $150,000 of FICA reported income, then you must go to a Roth contribution. So that's an after-tax contribution. Notice it's highlighted. Again, I'll come back to that in a minute. We already talked about the SALT cap going to 40,000, how that's limited by time and income. But in addition to that, we know that Americans will have a higher standard deduction. And the Republicans have still been on the road touting that Social Security is no longer taxable. Ladies and gentlemen, that is completely factually incorrect. What is correct is that seniors have a higher standard deduction, which means less of their Social Security payment will be subject to taxation, but it is not tax-free Social Security benefits. And again, this is where I think the average American hears tax-free Social Security benefit, and they're going to be a little disappointed when they find out that may not be fully accurate. There's a higher child tax credit. There's a tax credit for contributions to scholarship granting organizations within your state. I know some of you on the call are in Florida. You have a very generous scholarship granting organization program in Florida, for example. Your charitable deductions starting next year, if you're an itemizer, the first 0.5% of your adjusted gross income that you give in charitable giving is no longer deductible. It's only the amount above that 0.5% of your adjusted gross income. If you're a non-itemizer, there's an above the line charitable deduction. It just kind of assumes that you're making some charitable deductions and we're going to give you some credit for it. So that's actually a real great win for non-itemizing clients. The piece limits, the 80% cap was eliminated. Now there's a 100% haircut to deductions, again highlighted, and I'll come back to why. The alternative minimum tax, the phase outs were accelerated, and that means, again, it's highlighted. So all these highlighted sections, let me explain why I highlighted them. The one area of the tax law that I think is really getting missed when people are looking at it is there is a subset of US tax filers who will actually see their effective tax rate go up. And remember, it's the effective tax rate we really care about. And so those highlighted items that I mentioned earlier, all of those have the ability to increase one's effective tax rate. And that niche group of filers are going to be high income W-2 employees. And they're the families that will possibly see an increase in their effective tax rates. A couple other items, no tax on tips and overtime. That's not as clean and simple as it sounds. For example, on the overtime, if you're paid time and a half for overtime, it's only the half pay that is tax-free, not the one times pay. And again, I don't think most Americans realize that. In addition to that, all 1.5 times pay is subject to payroll taxes. For hourly employees, by far, that's the largest tax they pay. And so there'll be no reprieve in that tax liability. The opportunity I see for a lot of you on this call are opportunity zones. Starting in 2027, opportunity zones are going to be revamped to be much more attractive for a rural-based investment. Now, I think you'd all agree that the opportunity zones of previous genre were very urban centric. That's where you could really get return on your investment. Well, they've revamped that so that opportunity zones in rural America have a little less requirements on funding and so forth, and you can actually get a nice rate of return. So watch those rural opportunity zones starting in 2027. There are these new Trump accounts, which allow people who have babies between 25 and 28 to have $1,000, and we're seeing some philanthropic add-ons to that, which could be some interesting approach. And I'll come back to that theory here at the end. But bottom line is, got ahead of myself. Bottom line is on the personal tax filers, the mass majority of us will see a tax decrease in 2026 and beyond. But there is that subset of filers who could see a higher effective tax rate. So I really encourage you to meet with your financial advisor, meet with your tax professional if you find yourself in that category of being a very high income W-2 employee. Okay. So with that, let's talk about pass-through business owners. Most importantly, the SALT cap workarounds, or not most importantly, but importantly, the SALT cap workarounds are still in play. So if you're in a state that provided a workaround to the $10,000 cap, that's still effective and able to be used. The 20% 199A deduction is still in place, but make no mistake about it. The largest addition to economic growth inside this tax bill is bonus depreciation and interest rate deductibility and R&D write-off. Those are the things that really juice business owners to reinvest in their companies to grow them down the road. So that is very important that that was included within the O3B. That's also included for corporations and as well as pass-through business owners. So again, that's the biggest part. But a change in corporate taxation, you and I have a 0.5% floor on our charitable giving before we get to take a deduction. Corporations have a 1% floor of their taxable income before they get to take a charitable deduction. On the international taxation front, all the O3B did really was to clarify the United States will not be participating in a global minimum tax. We'll run a side-by-side program. So that's one thing. There are some changes around compensation and fringe benefits and the like, but bottom line, that's not overly relevant to the most of us. The most important thing is corporations are incented to rebuild and invest back in their business. Now, the lion's share of the way this tax law was paid for was cuts in Medicaid, but there are also cuts in Medicare, or excuse me, in Affordable Care Act. Those enhanced premium subsidies that we've now become more familiar with as That caused the government shutdown back in October. It's still an issue. I tend to believe there's going to be a workaround, either a shorter extension of time frame or a higher qualification requirement in order to qualify for those enhanced benefits. But I don't think there are enough Republicans that see that as a threat to their reelection opportunities that I think it's going to definitely be addressed yet this month or certainly early next month. But make no mistake about it, as I mentioned earlier, it will add to the debt and deficit. And I know what you're thinking. You're saying, well, hold on a second, Jeff. You're telling me the fiscal conservative Republicans passed a tax law that's actually going to add to the debt and deficit? Yeah, and I understand why you're confused. It's because that congressional dictionary, you cannot find the word hypocrisy. Remember, we're talking about politics here. We're not talking about ideology. And so in this case, the Republicans did pass a tax law. It's going to add about $4 trillion to the debt and deficit. And it also has implications for Social Security. We're all familiar with that drop dead date that Social Security is going to reduce benefits in about 2034. But because we're paying less taxes on our Social Security benefit, which actually goes to the Social Security Trust Fund, it backs that X date up to about 2032. So I just tell you that only because you and I are going to be voting in 26 and 28. And in those two elections, we will be electing people who will likely be overseeing Social Security reform for our country. And they will reform it. They are not going to let it go to a 20% reduction for everybody. That's not going to happen. But nonetheless, who we elect is important to oversee that process. And speaking of elections, let's talk about where we stand right now. Obviously, the 26th election is going to be a referendum on Donald Trump's economy, and it's viewed through a lens of affordability. That's healthcare, that's housing, that's childcare, all that stuff. And the Republicans haven't really had a good story along that line. So I do believe what you're going to see through the State of the Union address in February, through the road trips that Donald Trump will be making, along with all the Republicans, J.D. Vance and the like, they're going to be starting to frame out what they see as their affordability agenda. And we're starting to get some inklings of that, but we'll start getting a lot more meat on those bones. But certainly, history in an election coming out of an environment where Republicans control anything, Democrats have the advantage for taking back the House, historically speaking. And historically speaking, they should get 20, 30, maybe as high as 40 in an incredible year seats, which would blow the Republicans out of the majority by far. Because again, the Republicans right now really only have a 3-seat majority. But there are some complicating issues unique to 2026. We know we're doing these mid-cycle redistrictings. At the end of the day, I think that's going to be somewhat of a wash. The Supreme Court heard a case around using race as a methodology for drawing the House districts, and that could come down in such a way that it causes even more states to then redraw their districts down the road. So where are we at the bottom line? Bottom line, I do believe the Democrats will take back the House, certainly if the election was today. Now, you and I both know 10 months in politics is a lifetime. Anything can happen between now and the election. But the way I see it coming down right now, I do believe the Democrats will take the House. On the Senate, as you know, we only elect about 1/3 of the Senate every 2 years. So every class is unique. And the class of 2026 just heavily, heavily favors the Republicans. So I've listed here the states I think that are most interesting to watch, but the cartographic advantage that the Republicans have, I think is simply insurmountable. I don't think the Republicans could mess up 2026 badly enough to lose control of the Senate. So I think the Republicans will maintain control of the Senate. So we'll end up in a split congressional environment, which is, usually from a market perspective is a good thing. It means stasis. We know what the rules are. But at the same time, there are some big issues our country needs to face. But let's talk about 2028. I'm already looking down the road and thinking about what that looks like. And right now is somewhat anecdotal. If we ask Democrats, who's the leader of your party? Democrats, who do you see as the leader of your party? Democrats have a problem. Literally 1/3 of Democrats say nobody or they have no idea. And what may even be a little more concerning to Democrats is that almost 1% of Democrats actually believe Donald Trump is their leader. So clearly, Democrats are wandering through the woods, even as we stand here today, a year after Donald Trump's been inaugurated in a second term, trying to figure out who they want to be, politically speaking, in 2026 and beyond. Now, it's not that Republicans don't have a problem. We know that Donald Trump now has run and or been our president twice. And if you ask the Republican who's their leader, there's no ambiguity about it. It's Donald Trump. But it begs the question of who's next. And until Republicans are prepared to answer that in a more forceful way than at most 2.9%, that's a problem for Republicans in 2028. So we'll see how that all fleshes out, but that's what I'm watching right now. But what concerns me is when we talk about the primaries that we're entering into, we're just now entering into primary season for 2026. Sadly, only about 18% of voters show up. And what that means is that one out of every five Republicans are choosing which Republican the rest of us get to vote for. And one in five Democrats get to choose what Democrat we get to vote for. And what's very frustrating to me is that only 43% of Americans actually show up on midterm elections. This is the future of our country. My gosh, we should be able to have a better participation rate than one out of every two of us. Because certainly more than one out of every two of us like to complain about politics, then by gosh, more than one out of every two of us should be voting. And that gets me to the dislocation issue that I'm a little bit concerned about. I know I look at my own statements. I'm sure you're the same way. Markets are at an all-time high. It looks fantastic on paper when we open up our online accounts. Home values are at all-time high. Home ownership is close to an all-time high. Inflation is very manageable at 2.7%, and unemployment still considered in that full employment range. So everything looks fantastic. Then tell me why do 33% of Americans, or excuse me, why the confidence in the economy is so low, with only 33% of Americans suggesting the economy is in a good place. And even worse than that, 24% of Americans saying our country is going in the right direction. So this dislocation is concerning me, and I'm trying to figure out where that's coming from. The Michigan Consumer Sentiment Index is at 52.9. That's lower than 99% of the months over the last 48 years. Now, I'm 59, so I can remember these 50 years, right? There were a lot of really bad times in that 50-year history of America. And yet now, 99% of the time, people think today's worse. Yeah, it just throws me off. And I think it is this dislocation factor. And I'm often asked, where is this dislocation coming from? And I really do believe it's income and wealth inequality. And what I mean by that is 97% of US households, excuse me, let me say that again. 50%, the top 50% of households own 97% of the wealth, with the lower 50% only owning 2.5%. And now I'm not suggesting something's ill-gotten or inappropriate in that. I'm just suggesting that, my gosh, that seems very steep in a democratic representative environment. I would contend it's unsustainable. But what's equally unsustainable is the federal debt at 38 plus trillion dollars. And by gosh, ladies and gentlemen, we need to take action on these issues sooner rather than later. And the hard truth is very simply this. If you want to get our country back on solid fiscal footing, you can't tax enough to do it. You can't cut enough to do it, and we can't grow fast enough to do it. Until we realize it's going to take pain from all of those areas in order to generate an environment where we can get that outsized growth over a longer period of time, I think we're going to continue to struggle with these same issues. But right now, as a financial investor, we know tax rates are historically low. None of us like to pay taxes, but if you're going to pay them when they're low. So my suggestion right now is the goal of every financial plan that we're talking to here is to manage your effective tax rate volatility. And you do that by diversifying your tax exposure in retirement, diversifying away from one tax strategy. My biggest concern for the average American is they only have one tax strategy when they retire, and that's pay taxes because all their money's in 401k IRA. I'm suggesting you need to have a more diversified tax portfolio. So that's why your advisor is talking to you about Roth conversions. They may be talking to you about life insurance for possible tax-free income or these opportunity zones starting in 2027. Just diversifying your tax exposure so you get to manipulate the tax code instead of the tax code manipulating you. Now, more generically, take advantage of this very generous estate tax environment we're in. I will make one prediction. The prediction I make is when we do go through a tax reform effort, like a 1986 type tax reform, not a 25, but 1986, I do not believe wealth transfer opportunities will be as generous as they are today.
Oh,
So take advantage of what we know right now. And over the next 3 years, have babies so you can collect your $1,000 from the federal government. And in addition to that, review the totality of your tax changes. Remember, there is a subset of tax filers that will actually see their effective tax rates go up. And if you are that individual family, then you need to know that and prepare for it. On the charitable giving front, there's been some changes there in how we approach that from a financial planning perspective. And your advisors are well familiar, well steeped in those strategies. So make sure you're including them. I would contend that charitable giving is still an extremely valuable planning tool in everyone's financial plan. But equally valuable is long-term care planning. You and I both know those long-term care expenses are quite large. And right now, there's no funding source for that other than cash flow. So having a strategy for dealing with long-term care planning is a must. Now, I've taken way too much of your time, but I went through it very quickly. But if you open up your phone's camera, focus it on the QR code here on the right side of the screen, that will actually send an email to me, and I can send you the full presentation, which gives you all the slides we talked about today, plus some we didn't have time to talk about. So, Jeff, I'm sorry. I hope I didn't overspend my time, but just wanted to get all that information to your audience.
I think it was exceptional, and most of us, including me, is probably going to have to watch this a couple times to gather every detail that was so insightful and as well helpful. Obviously, you have a website that we'll all take a close look at. I'm just going to touch on a few of the, I think, key points that may apply to us and where we're at in our lane as it relates to guiding and counseling our relationships. And that is one, the 401k plan. I've mentioned this on our Friday market updates that we do every other week for about 5 to 10 minutes about how if you make over 150,000 of taxable income, you will now, if you're contributing to a 401k plan or some of the like, you can catch up and make a larger contribution than the 24,500 that you can contribute pre-50 with an $8,000 additional contribution that now has to go in after tax. I don't see that as a huge disadvantage because of the point you just pointed out, and that $8,000 is like a Roth IRA that grows tax-free. Many of you that we work with is taking advantage of these types of plans, like the Roth IRA and the Roth conversion. So I believe that that is very helpful, and we've talked about that already, and we'll talk about it more. You know, what's interesting to me is a comment you made about the $4 trillion deficit, but on the heels of that comment, you had mentioned the fact that the pass-through S corps and the C corps have the ability to spend money and take a much more favorable deduction against their taxes. Now, granted, if you just look at the historical numbers of money spent and such, you don't have the ability, and this is the part that really drives me bonkers, is like when you balance a budget and you actually make recommendations or proposals in order to change tax code, you're only capable of using the calculation based on historical numbers, but you're not making calculations on the motivation of spending. Now, we've seen this market for now 3 going on 4 consecutive years have year-over-year earnings growth double digits. I'm going to remind everyone, when I started in the business in 1995, and for the next 10 years, I watched earnings growth from the S&P 500 year-over-year at 4 to 6%. That was considered great. We're coming off of 2025, Jeff. We're looking at 12% earnings growth year-over-year and projecting for 13 next year. What about the dollars being created for taxes there? We don't calculate that for the $4 trillion of so-called deficit. And hypocrisy is that, not the fact that they're talking about reducing the debt. I think you have to have economic activity, and government control can really stifle that economic activity. What I'm seeing is the ability for companies to go out and actually have a clarity of execution that's going to benefit their bottom line and benefit our economy. So I just want to make that point. And I will pause at the end, and unless it's mandatory, you talk now on that topic.
It's your show. It's not mandatory I talk.
Well, if it's timely, though, it's not my show.
Well,
It's my
I
audience's
do
show. So go
Yeah, I
ahead.
would like to throw something in. I totally agree with you that there's the incentive for business owners to reinvest in the business, and that should drive economic growth. But the $4 trillion net cost of the tax bill assumes that economic growth in there. That was the dynamic number, not the static number.
Is that
Okay.
right?
Yeah. So that's one little issue I'll take with that. And then
How do
second
they
of all, keep in
calculate the
mind,
benefits of a tax deduction
Say again.
Or how do they calculate that? Uh,
That's where you are correct in the sense that they have to pull things out of the air, right, to make assumptions. And where there's not going to be the juice in this tax bill is that business owners were already able to deduct a lot of those expenses anyway. But the only change is they got extended. They thought they were going to run out of that
so
opportunity.
you're telling me that a capital expenditure had 100% depreciation last year?
No, 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 no. It
So
had been coming down. Yeah, it
yeah,
had
it
been coming
graduated
down,
from
and it was
100
supposed
down to
to,
20%, and it's now
right.
back to 100. So, I mean, listen, I just think that the way you calculate the benefits of these tax reforms is broken. I just believe it. I've watched it. I'm the 50 plus person yelling at the TV about how I disagree. So it sounds to me like it's not totally off kilter, but it's still needing some
Yeah.
addressing. And you know what? Here's the deal, Jeff. You and I have been together for years now. I'm going to be interviewing you years to come. I will not forget this moment. We'll talk about it. If that
But no,
$38 trillion goes down or up, you and I will talk about that.
fair enough.
Okay. I'm going to continue on that a couple other takeaways. By the way, excellent work, Jeff. I really appreciate the way you take such a very complex, call it topics and relevant details as it relates to the tax code and changes. And you really simplify it in a fashion that even I can understand, which is very difficult. I noticed that the dislocation of 50% of the population owning 97% of the wealth. And I think it's an issue. I really do. I think we're on this earth. And we forget this many times to make this earth and this country a better place. And I think sometimes greed can get in the way of that ultimate objective that I think we're here for. But let me ask you this. How do the other countries match up to our country, the United States, the greatest country? How do we match up to other countries' division of wealth?
Yeah. Well, let's go back to Iran. Let's go back to the 1970s. And the reason why the Shah was overthrown was because of income and wealth inequality, right? And now we have the Islamic regime in Iran, and income and wealth inequality has now gotten increasingly progressively worse. And that's why they had an overthrow. You go back to the Russian overthrow and revolution in the early 1900s. It was economic and wealth inequality. My point, and I'm not suggesting we're standing here on the precipice of a civil war or a violent takeover of the United States. All I'm suggesting is that at some point,
Going the
if
wrong
that
way.
50% gets their ducks in a row, they say, "Hey, we can elect who we want, who will carry our message." And our message is we want some of that money. And
That
so
makes
I'm
sense.
suggesting that we probably ought to create an environment where people can participate more broadly in growing wealth for their families. That's all
Love
I'm
it.
saying.
I appreciate that. And it actually answers a lot of my questions as to how people vote.
Yeah.
So I heard you very clearly that the House has a high probability. I think you told me prior to this call, 35% probability that the Republicans lose. I should say 65% probability the Democrats take back the House, and a very high probability the Senate stays. And in my history, that leads me to believe that you have a stalemate. I think one of the bigger concerns that we don't want to deal with, whether you like the current president or dislike, or both for that matter, is that the impeachment process will be stifled with an impeachment that doesn't go fully through the Senate, which I don't want to deal with any of it. I don't think any of our audience does.
No.
But at the same time, at least we know we have somewhat, if that goes in that direction. I guess my question to you is an extension of that.
Let's game that out, Jeff.
Okay.
Let's say that you and I are right, that the economy is doing fantastic in 2026.
Okay.
Okay. But Democrats squeak a win out. And I think when I say Democrats are going to take the majority, I think it's going to be a 5 to 10 seat majority at most. Right. So it's
House.
still going to be the House.
House.
Yeah.
Okay.
And so those Democrats are going to say, okay, well, we may not care for some of the methodology, but we can't argue with the results. And so they can't really fight. I don't see them swimming upstream aggressively if the economy does what you and I think it's going to do this year. Now, if the economy is in a bad situation, Democrats are going to easily win. And then that's what I think when you have to have more concerns about the investigation and the impeachments and all that kind of stuff.
Well, I hope you're right, mister. I hope you're right. I haven't seen very much of that lately. Of
I
always
understand.
doing a good job, I'll let it slide. I haven't heard that very much in the last decade. Um, I think your comment about the balancing your assets between tax-free growth, taxable, and tax deferred is critical. We've talked about it
Mhm.
consistently, and I will bring one point to that. Having worked in 30 years, 3 decades in this role, having worked with generational wealth versus new wealth, I find that the generational wealth attacks that more effectively. My job is to educate the newer wealth to understand that difference. And I also believe the estate plan. Listen, when I first came into the industry, I believe that number was less than $1 million that we could pass to the next generation.
Mhm.
And the reality is today we're sitting here at 15 plus per
Yeah.
person that we can pass. I think the wealth has grown more than 15 times in my career. I will tell you that. Thinking about how much I spent on certain items back out of college, I remember I used to park in a parking lot that was $2 versus the one that was closer to my office that was $3. My approach has changed. That same parking lot is now 20 or $40. So I'm not
Yeah.
sure that that aligns 1 to 15. But the point is, I think that this is the best situation we've seen, and if we've learned anything from the elections that come and go, that's probably going to be the best we're going to see. So let's plan accordingly. Um, I think the one thing I want to thank you on all of that, and I just summarized what I think is helpful for me to interpret what you're saying, and I'll ask you to add to anything that maybe I left out. But the fact is, in election years, one side of the aisle wants everything to look horrible. Well, let's have as much commotion as possible, man. We need change. This is scary. Minneapolis comes to mind. We're already starting to see that, which is really hard to watch. And then you have the other side of the aisle. This is the greatest economy in history. You got both sides, right? And the
Mhm.
volatility that persists from that type of, call it, uncertainty. Any thoughts on how the market might react? And I'll give my 2 cents based on your guidance as well
Yeah, I
relative
think
to the pre-election.
yeah, one, I think the environment is accommodative to economic growth at this point. You listen to CEOs and what they're saying on their earnings report, they seem to be rather bullish. I think we're set up for a very solid 2026. I'm not in your business, so you tell me what you think. But certainly, I think the government has certainly set up an environment, and the circumstances are played out in such a way that we should anticipate a very solid year in the markets and so forth in 2026. And I am more confident about that than I have been in most years. Let me put it
Well,
that way.
I just think the 100% depreciation on CapEx spending and R&D credits being put back on the balance sheet to the tune of 242 billion, also back, call it reversed for dollars that had been contributed, and we're actually doing a lot of planning for clients using those carry forward tax
Yeah,
write-offs to convert Roth IRAs or IRAs, right? I just think
right.
there's a lot more money in the system because of those changes and the ability for companies and planning to spend on capital expenditures to improve their business will bring down their tax base. And let's not forget, by spending money, you're creating taxes from
Mhm.
the seller. I just think those things are not being categorized, and I believe the frothy market we look at daily here on our side of our job, and the PE ratios extended greater than the averages of 19 times earnings. Now we're looking at 22. I think that earnings growth is critical. I think we're entering a new phase. I think we're
Mhm.
entering a new generation of efficiency and ability to get things done with less and all the things that come with it. And I am very compelled and more excited about the markets today than I have been in previous periods of time. And, the uncertainty that comes our way this year that creates volatility, whether it's the Supreme Court. I think this market's reacting more to the Supreme Court next, call it, decision as it relates to these tariffs than maybe some of the earnings that we've seen the last couple of days with Delta and all the banks, with the exception of Wells Fargo, beating in both top and bottom line. And I think the best is yet to come, as my friend Frank Sinatra once said. I think our earnings season is going to be robust for the fourth quarter, and I think we'll have a strong. That is something we're watching. The data, the liquidity in the system, the deregulation that's allowing business activity, the big, beautiful bill clarity, and the earnings growth that we've seen that is unprecedented has to maintain the focus of the long term. But let me tell you this, I've been doing this 30 years. There's something I don't know. There's something you don't know. There's something that's coming that we can't foresee. So you need to be more conservative with your liquidity relative to your needs today and for the next several years. And then the dollars you're not going to need, it is time to go. We need to make sure we're combating inflation because that's our biggest headwind today. And I thank you, Jeff. You've given me a lot to think about. You've given me a lot of facts that have me look at things differently. And I'm going to call you back in before November to see if the probabilities have changed, what's come about. And we're going to question a few things, including that deficit down the line. And I think my audience, I usually get us going at about 40 minutes after the hour. And today I kept you a little longer because it was worth it. Jeff,
Oh,
you're
thank you.
a phenomenal partner, and I appreciate you taking the time to talk to us today.
Thank you. I appreciate your partnership as well.
Thank you. See you soon. Bye for now.